value of zero, I think in this case is very true. And look, the bottom line is that, the central banks, they don't care about any of these correlations. They're just trying to, I think, de-dollarize and accumulate metals. And they're the ones, in my opinion, that are pushing this up. And I don't think you've really begun to see anything yet, because there's an old statement that says there's no bull market like a gold bull market, because it speaks to a different mentality. It doesn't speak to wanting to make profit. It speaks to protecting your ass. And this is why you see at 3 p.m. last Thursday a $1.6 billion sale of gold futures in about 3 minutes, which temporarily knocked down the price. But, you do something like that, you're either a complete and total moron or you're doing a drive-by shooting. Because when you sell that large of a position, the idea is to bleed it out over time, not dump it onto a very thinly traded market at the end of the day, when really it's in a transition between, New York and Asia, and it's just complete stupidity. But anyways, bottom line is, yeah, it does seem like this is different. It seems like the central banks, in my mind, are choosing gold over treasuries.
In this intriguing analysis by Andy Schectman, he sheds light on the unprecedented strength of gold amidst challenging market conditions. Despite dwindling U.S. retail demand and ETF outflows, Schectman suggests a clandestine trend: central banks quietly accumulating gold. Citing data from the Bank of Montreal, he indicates that China alone has purchased gold for 17 consecutive months, potentially amassing a staggering 38,000 metric tons. Schectman argues that central banks, unconcerned with conventional market signals, view gold as a hedge against currency devaluation and geopolitical turmoil. He warns of the repercussions of U.S. sanctions on nations like Russia and China, which could further drive central bank gold accumulation.
Well, it sure seems like a breakout. It's exhibited unbelievable strength and resiliency in the face of so many things that people would say would be negative for the price of gold. Certainly no U.S. retail demand, hardly at all, in the respect of where it should be. ETFs bleeding out. Now, I was talking to my buddy Bill Holter. I said that to him today about the ETFs bleeding out. And he said the same thing that I believe, that the bleeding out is actually those people who have the ability to bleed it out, taking physical possession of that metal, and what looks like share redemptions is actually metal redemption. It's an interesting thought, but I mean, you have people that have been selling into the rally, is the moral of the story, along with, positive real yields. Now, I said that to Bill too. He said, yeah, bullshit. There are no positive real yields. The numbers are fake. And I believe that too. I mean, the inflation numbers are fake. But the point of the matter is that in my mind, the central banks that are accumulating it, they don't care about these signals or about these correlations between rates or a strong dollar or the divergence between gold and rates. I think if you look at a comment that was made by the chairman of the Shanghai Gold Reserve in 2014. Now, again, you always hear they think in terms of years or decades. We think in terms of minutes. The guy says that the Shanghai Gold Exchange will change the current gold market with its consumed in the East but priced in the West arrangement. When China has the right to speak in the international gold market, the true price of gold will be revealed. And this was in 2014. And when you see the amount of gold, 17 straight months that the Chinese have bought, according to the Bank of Montreal analysts, understating how much they really own. Alistair McLeod would tell you they own 38,000 metric tons, 20 by the state, 18 by the people. But really what I see happening, and I would say, look, there really isn't a real top for assets like gold in dollar terms, because, just like who wants to be the last one holding worthless paper, I think is the way that the central banks are looking at it. Of course, Voltaire's statement, all currencies revert to their true value of zero, I think in this case is very true. And look, the bottom line is that, the central banks, they don't care about any of these correlations. They're just trying to, I think, de-dollarize and accumulate metals. And they're the ones, in my opinion, that are pushing this up. And I don't think you've really begun to see anything yet, because there's an old statement that says there's no bull market like a gold bull market, because it speaks to a different mentality. It doesn't speak to wanting to make profit. It speaks to protecting your ass. And this is why you see at 3 p.m. last Thursday a $1.6 billion sale of gold futures in about 3 minutes, which temporarily knocked down the price. But you do something like that, you're either a complete and total moron or you're doing a drive-by shooting. Because when you sell that large of a position, the idea is to bleed it out over time, not dump it onto a very thinly traded market at the end of the day, when really it's in a transition between New York and Asia, and it's just complete stupidity. But anyways, bottom line is, yeah, it does seem like this is different. It seems like the central banks, in my mind, are choosing gold over treasuries, which have the risk of not only default, but in the case of our brain dead Treasury Secretary, who in Brazil said, a member of Brics, we need to confiscate, not just sanction, the Russian Forex reserves. And now she's at it again. And in an interview with CNBC from the, it's too stupid to be stupid category, she says the United States is prepared to sanction Chinese banks and companies, as well as Beijing's leadership, if they aid Russian military in its invasion of Ukraine. Well, it's okay for us to aid the Ukraine, but it's not okay for China, their ally, to aid. So now we're making demands. And, she goes as far as to say, that we stand ready to act if we see significant violations, and it's anything that involves Russia's military aid is unacceptable. And the whole thing is nuts. She says China is entitled to have a relationship with Russia, but anything of military aid, well, we're going to sanction you. Now, this is the whole driving force behind, I think, the strength in commodities, strength in gold, is that these countries look at gold, which has outperformed for 25 years a treasury bond by a huge margin. It's outperformed the S&P, and it's done so without counterparty risk, without sanction risk, without default risk. And I think this is what is putting a floor under the price of gold, which I expect to continue to rise.
In this segment, Andy Schectman discusses the erosion of Western exchange dominance and the emergence of a new Brics currency backed by gold. He cites a Kremlin aide's remarks on the need for alternative pricing mechanisms and Moscow's shift towards trading grain in national currencies. Schectman anticipates a tipping point where exchanges like Shanghai challenge Western hegemony, leading to a re-evaluation of commodity prices.
I mean, look, I think you could argue to a degree it has been exposed. I mean, it has. Let me read another thing to you here, because it's important to understand who's exposing. I talk all the time about people that are well-read, just they read the wrong shit. And that's the bottom line. They just read the wrong stuff and they don't pay attention. But the people that matter, right, they get it already. And this was, I mentioned on several interviews last week, that there was an article in the news agency TASS and the Kremlin aide Yuri Ushakov, and he's talking about the Brics currencies, the new currency that's coming. And he reiterated a lot of the stuff that we've already said about it being a basket, two baskets, one of national currencies and one of commodities, largely gold. He said it would be digital, and this is the Project M-Bridge, which is the cross-border payment system that allows these countries to trade and supersede the SWIFT system. All of these things we've known, we've been talking about it for a long time, but here's the interesting part of that article that people need to understand, and it goes exactly to this question. Who knows it? Well, the people that matter know it. And he says the second part is price. He says for the moment, price is determined by Western speculation. We produce these commodities, we consume them, but we do not have our own price mechanism, which will balance supply and demand. During the COVID panic, the price of oil fell to nearly zero. Now we know it went to negative 40. So he's a little off there, but he says it's impossible to make any strategic planning for economic development if you do not control prices of the basic commodities. Here's the interesting point right here. Price formation with this new currency should get rid of Western exchanges of commodities. So they understand. In fact, they just developed the Brics grain exchange, and he talks about global prices are primarily determined by the Chicago Commodity Exchange. Moscow also seeks to move away from trading grain for US dollars in favor of national currencies. They understand that the prices of commodities are controlled by the COMEX. And for a long time, I would argue they have been using it against us. This is how they have slowly and methodically drained the exchanges. This is how they have taken possession of so much. But more importantly, this is how they have accumulated so much of what they see as vital and important, the only other tier one asset in the world, gold, at subsidized prices. It's using your opponent's aggression or leverage against them. And that's exactly what they're doing. Until bang, all at once, the Shanghai exchange or the Moscow exchange or the exchange in Dubai takes over the price. And you can already see that slowly happening by the arbitrage that we're seeing in Shanghai with silver price as much as $3 an ounce higher. So they are enticing those traders who have the ability to take delivery or buy the make-believe price on COMEX and in the West, in London, and deliver in Shanghai at a premium. And this is, I think, the beginning of the ultimate exposure of the COMEX. And look, it won't happen. It won't happen probably the way that we all think it will play out. But at some point, people are going to say, I'm not going to deliver at any price, let alone this make-believe price in the West. And that's when the real price starts to set in the rest of the world in places like Shanghai Gold Exchange, which is largely cash and carry. So there's always a price, but what is that price? So yeah, I think it's already being exposed and by the people that actually matter.
Today's discussion with Andy Schectman has provided valuable insights into the current state of the gold market and the evolving dynamics of global finance. We've learned about the remarkable strength of gold amidst challenging conditions, driven by factors such as central bank accumulation and geopolitical tensions. Schectman's analysis sheds light on the shifting power dynamics in commodity pricing, with the emergence of alternative exchanges challenging Western dominance. As we reflect on these insights, we invite you to share your thoughts in the comments section below.